All right, so let's start with the new reading, capital investments and capital allocation. So first of all, in this reading, we are going to discuss what are the types of capital investments, or when we say capital projects. So we divide the capital investments broadly into three categories. One is called that we are investing in capital projects for going concern purposes. We are investing in capital projects for regulatory purposes or compliance purposes, or we are investing for expansion. So, what is going concern projects? We divide the going concern projects into two categories, or the reason of investments in the going concern projects is two. One, we wanted to maintain our current business operations, okay, or we want to reduce the cost. Okay, so if I wanted to reduce the cost, that means I would be investing in any kind of project that is going to improve the efficiency. All right, so let's have for example, if for the when I say the maintaining the business, or maintaining the going concern or ongoing operational activities, we wanted to replace the old machinery. Okay, that is an investment, that is a capital project. The purpose is maintain the business. We are repairing the equipment. Why? Because obviously there may be a fault in the equipment. Why? Because we want that we are not going to face, or we should not face any disruptions if the equipment is not working well. So the aim is we wanted to maintain the business or ongoing operational activities, or we want to upgrade the technology. The purpose is efficiency. The purpose is we wanted to reduce the cost. So these are basically the going concern project. Either we are investing for maintaining the business, or we are investing for the cost reduction purposes. So what type of approach we should use? Very simple, match funding. So let's say the project is, let's say we want you to replace the old machinery and the life of the new machinery is 20 years. So I should go for 20 years of financing. Let's say I wanted to take a loan. I will go for borrowing for 20 years, loan for 20 years. That is match funding approach. All right. And as an analyst, we can also predict, or we can also estimate the capital investments or capital investment needs for going concern project by looking at the annual depreciation expense. Clearly, for example, if majority of the depreciation have been charged, so we can estimate that in the upcoming year there will be a capital investments from the companies, right? So this is all about going concern projects. Then there are certain regulatory or compliance projects. These are for regulatory requirements. So for example, for safety requirements or environmental compliance purposes, or any project that is required by law. It can be safety related, it can be environmental related. So obviously, because these are we are doing these projects or carrying these projects because of the regulatory requirement or compliance requirement. So obviously these projects may not be generating any new revenue, right? So because the purpose is compliance, purpose is not investment, purpose is not revenue generation, right? So because our target is not revenue generation, so complex decision making is not required at this level. And the third category is basically the expansion project. So the purpose or the expansion is we wanted to grow the business. Obviously, if we are growing a business, we are moving into different countries, or we are entering into different markets, or we are introducing new products, obviously, right? So it involves a complex decision making. So we have to go for a detailed analysis of forecasting revenues or expenses, so that we can analyze that which of the chosen projects, or which of the following projects. Let's say the management have 10 ideas, 20 ideas, right? So which of those ideas we should choose? We will go for complex decision making, right? So these are broadly three categories of capital investments. All right. So Now, let's talk about what is the capital allocation process. What does this mean when we say the capital allocation? The purpose is, or we are trying to identify where to invest the money, where to invest the cash that companies have. That is, we can go for investment in buying a new machine, expanding businesses into another geographic area, moving the corporate headquarters, or replacing a delivery truck, right? So these are all basically the capital allocation decision, where to invest the money, right? So we have to identify, we have to evaluate the different capital projects. So as I was discussing, let's say the companies have, or the management have 20 ideas or 15 ideas, so we have to choose from those ideas that which of the following, which of those ideas we should go for that we are going to evaluate. We are going to look at the cash flows of those different projects, we are going to look at the expenses, we are going to look at the revenues. So basically we have to choose, because obviously given the time limitation, given the resources limitation, which is a fundamental of economics, we cannot invest, or we cannot continue, or we cannot go for all the available projects. So we have to choose that which project is more suitable given the current scenarios, given the current resources we have. So why it is important, why we are evaluating the capital project? So because we are investing in a different projects that can change the shape of the future of the firm, right? So it can be so important, so that's why we have to evaluate, right? And we have to evaluate it very carefully. That's why I said that the complex decision making is required. Secondly, because a huge investment, huge cash outflow is required when we are investing in different capital projects. So that's why it's important that we have to go for a rigorous analysis, rigorous process, so that because a huge investment is required. And second, and the last point is because investing in different capital projects is directly linked with the shareholder value, which is the primary goal of the board of directors or management. So if the decision is good, because that we don't know right now, that the outcomes we are going to receive in future. So if the decision is good, we'll have higher profit and obviously higher value. Shareholders will be happy and they may go for lower required rate of return. So what is the process? What are the steps? So first of all, idea will be generated. Okay. So the management can be, the ideas can generate it from number of sources. For example, it can be from senior management. Senior management can give us that multiple ideas. Okay. It can be from functional divisions, those divisions in which actually the products are being produced, or the functional departments or employees or sources outside the company. So let's say at this stage we have 20 ideas, different ideas, that okay, so we can invest in these 20 projects, but obviously we cannot invest probably in all these 20 projects. Now we have to scrutinize those projects, which is called analyzing the project proposal. Shall we accept all the project, or which project we are going to reject? So the decision making of acceptance or rejection will be based upon the future cash flows, and for that we are going to look at different methods like IRR, like NPV, and other than the cash flows, we are also going to analyze the expected future profitability of those projects. So obviously selecting different projects from the idea generation stage, we have to look at the cash flows, we have to look at the profitability, and for that we will be using different models like IRR, NPV, or ROIC, return on invested capital. Now the third step is we are going to create a budget, right? So clearly in step 2 we have scrutinized, let's say 10 out of 20 projects. 20 ideas was generated for different 20 projects, but we decided that based upon the cash flows and profitability, we can only go for 10 projects. Now I have to invest in 10 projects. Now the point is I cannot probably invest in all these 10 projects at once, right? So I have to prioritize the projects based upon their profitability, based upon their timing of the cash flows. Obviously those projects which are going to give us the cash flows very quickly, those projects which have lower payback period would be preferred. Those projects which are more profitable would be preferred, right? And we also need to understand, or I mean, the prioritizing or choosing the projects from scrutinized projects from step 2. We are prioritizing based upon profitability, based upon cash flows, based upon the company resources. I mean, in company resources, everything cash flow is the resources, right? So employees are the resources, land, labor is the resources, right? So we need to look at the company's available resources and how those projects are linked with the strategic plan of the companies. All right, so because I mean, by looking at the cash flows, by looking at the profitability, some projects would be very attractive, would may seem very attractive, but they may not align with the strategy of the company. I mean, probably they may not make sense strategically, even so having higher cash flows or profitability, right? So at step 3 we are going to, this is what we do. And obviously after step 3, once we have created the projects, we have chosen the projects, we have prioritized the projects, now obviously after step 3 we would have invested the money in different projects. And at step 4 we will be monitoring our decision, because evaluating the projects, choosing the projects, analyzing the projects, it all involves future, not right now. So that means all these stages involves forecasting, estimation, everything like that. So once we have invested, now we will be comparing actual results with the projected results. And if the actual results are different than the projected results, we need to identify what's the reason. I mean, why the actual performance is being diverted from what we projected. What's the reason? We will investigate, right? So this is called post audit. And obviously we will try to identify the variance analysis, or I mean the difference between what we forecasted and what we are actually receiving, so that we cannot repeat the same mistakes for other projects in future, right? So this is the monitoring, decision, and post audit. All right. So what are the methods we have regarding the selection? I mean, regarding acceptance or rejection of different capital projects. So one method we have the net present value. It's a very simple method. We take the future cash inflows and outflows, and then we take the present value of those cash flows in today's term. So any project, what's a decision making criteria? Any project that has the positive NPV shall be accepted. Why? Because we are anticipating that in today's term, if we invest in those positive NPV projects, those projects are going to generate sufficient cash flows in future. That means having higher and sufficient cash flows in future is going to increase the shareholder value, right? So that's why we will choose those projects that have positive NPV and reject any project that has negative NPV, right? So for the purpose of net present value calculations, we need the discount rate. And what is a discount rate? It's simply the cost of capital, right? So let's say I need $100 billion for my projects in different projects. So at what cost I raised this $100 billion. Obviously some of this would be debt and some of this would be equity, and debt has its cost of debt, equity has its cost of equity. So we'll calculate the weighted average cost of capital, and we will look that what is an average cost of capital raising this money, and then we are going to invest in different projects. Obviously, I mean, this is my source of capital. This is my source of money, the money that I need, or the cash that I need for different projects. And then I will evaluate different projects based upon their cash flows, present value of those cash flows basis. I mean, these projects may be more risky compared to the source from which I'm generating this capital, right? So we can adjust. The purpose is we can adjust this cost of capital depending upon the risky nature of the project. Clearly, if the project is high risky, we can go for higher cost of capital or higher discount rate. Okay, and the last point regarding net present value before we go for the calculations, it must be after tax. Do not forget this. All the cash flows must be after tax basis. Okay, I'm not going to teach you how you used to calculate it on manual basis, probably in your previous studies in the accounting or finance studies, but we are going to learn how we can do this calculation in the financial calculator. So I have taught you already this, that what is the meaning or what should we do. Project with positive NPV, accept. Negative NPV, reject, because positive NPV means it is going to increase the shareholder wealth. Negative NPV means it is going to decrease the shareholder wealth. All right, so let's go for a calculation. So let's say we have these cash flows. We have cash outflow in year 0. So let's draw the timeline. Year 1, year 2, and year 3. So this is year 0, year 1, year 2, and year 3. So here we invested, let's say if we invested $100 million in a project, and we are expecting that in year 1, this project will generate $25 million inflow. In year 2, it is expected to generate $50 million, and in year 3, it is expected to generate $75 million of cash flows in year 3. So I mean, the point that we are deciding here is, shall we invest in this project or not? And where this $100 million will come from, we have different sources. So out of this, I mean, some would be from debt, some would be from equity, and together the average cost of this capital given in this question is 9%, right? So now let's analyze that. Shall we accept or not? We are going for net present value. Now I'm going to teach you how you can calculate the net present value by looking or from the financial calculator. So let me take you to the financial calculator. Okay, so this is the financial calculator in front of you. All right, so first of all, always this must be your habit. Whenever you are going to do a calculation, what you need to do is you will use this second and clear work. So this practice or this habit will make sure that whenever we are going to perform any calculations, the calculator memory is clear. Otherwise, calculator is programmed and it saves your previous calculation. And if you do not, I mean, without erasing your history, you are going to perform a new calculation that could give you a wrong answer, obviously. So how we are going to calculate? Okay, so first of all, I need to enter cash flow. So I will press this CF. Okay, and then first of all, my cash flow was outflow. So 100 negative. Okay, so I press 100, then I press this negative, the reset button. Okay, and then I will enter, then move down. This is cash flow 1, which is 25. Enter, move down. This is frequency, how frequently or in 1 year how many times we are receiving the cash flow. This is the frequency. So frequency is set as 1 because we are assuming that in 1 year or on per year basis we are receiving cash flows once year. Then I'll move to the cash flow 2, which was 50. Enter, arrow down. This is again the frequency, and I'll move to the CO3, which is my third cash flow. It was 75. Enter, down, and I will move to the net present value. Here I is the cost of capital. So in our question it was 9%. So you only need to enter 9, then press enter, then arrow down. Here we are at the net present value. So I will press net present value, arrow down, I will press compute. So my net present value is 22.93. Okay, so let's move here. We got 22.93. So rewind this video and see again how I perform this calculation. You must have a grip on this, how you are going to do the net present value. through the financial calculator. So now let's move to the decision making. Shall we accept the project or not? Yes, we should accept the project. This project is going to give us 22.93 cash flows on a net present value basis. Okay, cash flows we are going to receive in future, but we have to decide today whether we should go for investment or not. So that's why we are analyzing it in today's basis. All right, and now let's move to another method of measuring is the internal rate of return. If we are investing in a project, okay, and after considering all the inflows and outflows, what return I am expecting from that particular project, that is called internal rate of return. And also the internal rate of return is a discount rate at which net present value of any project is zero. Okay, so remember IRR, the meaning of IRR is if we are investing in project A, right, after considering all the inflows of this project and all the outflows of these projects, what should be or what return we are expecting from this project, that is the internal rate of return of this particular project. Remember, we are evaluating the project. We are not evaluating all investments at once. We are targeting one project, one investment at one time, right? So this is the IRR, and the other theoretical meaning of IRR is this is the rate, this is a discount rate at which present value of inflows and present value outflows would be equal. That means this is a discount rate at which NPV of a project is zero. Okay, so how we are going to calculate? First of all, let's learn how we are going to calculate. We'll move to the financial calculator and I will perform the same calculation again. I will repeat the calculation for you, although this data IRR calculation is based upon the same data. So remember, if I go to the cash flow, look, the data is saved. All the data is saved. So I need to remove it. So I will go for a cash flow, second, clear work. Whichever the function you wanted to reset. So let's say I wanted to reset the cash flow function. So I press cash flow, then I press second, then I press clear work. Similarly, if I go to the NPV, look, the data is saved. So I need to clear it. So NPV, second, clear work. Now, what I'm going to do, we wanted to calculate IRR. So I will go to the cash flows, cash flow. I will press the cash flow for, okay. All right, so first is outflow 100 negative, enter, arrow down. So this is my first cash flow 25, enter, arrow down. Its frequency, skip it, again press arrow down. So we have 50, enter, arrow down, again arrow down. So we have 75, enter, arrow down. Now I will move to the NPV. In NPV, I need to enter the discount rate, which is 9. Enter. Now what I wanted to calculate now, I want to calculate IRR. So I will press IRR and compute. So I got an IRR of 19.43. So we have got, from the same example, we have got 19.4377%, which you can see from rewinding the video. Right? We have got, if we are investing in the project that we are discussing, that is in our example, like this is a project. So this project is expected to give, based upon these inflows and this outflow, the IRR of this project is 19.4377. All right. So to invest in this project, I have generated $100 million at an average cost of 9%. So clearly, this project is expected to give me 19.43%, but my cost of capital is 9%. So clearly, as long as your IRR is greater than cost of capital, accept the project. Otherwise, reject the project. All right. Now, this is a decision rule that I just discussed. Okay. Now, the very, very important and theoretical point that we are going to discuss is the required rate of return. So let's say if I am analyzing the project A, okay, and I wanted to generate $100 billion and $100 billion I am generating at 4%, right? So Logically, if I am generating $100 billion at 4%, so when I should go for investment this $100 billion in the project in the same country where I generated $100 billion, in the same country where cost of capital is 4%, so logically I should accept, or I should require 4% as my required rate of return, right? But this project can be more risky than the sources I use to generate $100 billion. Okay, so remember, if the project in which we are going to invest is more risky, then we can increase the required rate of return. Like for example, if the project is more risky, I would say okay, 5% or 7% is acceptable for me. And if the project is less risky, we can accept lower required return compared to our cost of capital, right? So this is exactly the meaning of required rate of return versus the cost of capital in terms of the projects. So now, obviously, as we are discussing that the project risk can be different than the sources we are using, the risk of these sources, right? So obviously, let's say there is a bank in this scenario, right? We are generating $100 billion from this bank. Bank is the investor, and we have generated $100 billion, and we are the investor in this project. So if bank is demanding 4%, that is the risk analysis of bank. Given the risky nature or riskness of our company, bank is saying okay, I'm fine with 4% as my required return. But if we are analyzing, or we have come up with a decision that project A would be more risky, then we have to adjust the required return. Okay, so the adjusted required return, remember, normally the cost of capital and required return are same, but in certain scenarios it can be different. So we will adjust required return based upon the risk of any different particular project. So adjusted required return is now called as hurdle rate. Now in the scenario of hurdle rate, if I wanted to invest, or the decision about acceptance or rejection of a project should be based on IRR versus hurdle rate. So if IRR is greater than hurdle rate, now the decision will not be based upon IRR versus cost of capital. Now the decision should be based upon IRR versus hurdle rate. So as long as IRR is greater than hurdle rate, accept the project, otherwise reject the project, right? So we have calculated this. Now, very simple, straightforward. Conventional means when the sign of cash flows do not changes over the course of the project or life. So that is conventional cash flows. In case of conventional cash flows, or if the project has conventional cash flows, IRR calculation is more simple or very straightforward. But in case of unconventional cash flows, the project can generate multiple IRRs, and in the presence of multiple IRRs, it would be very difficult to analyze the project. Okay, so that's a problem of unconventional cash flows. Let's talk about the advantages and disadvantages of NPV and IRR. We have discussed NPV one advantage already, that NPV gives it's a direct measure in a sense that, theoretically, if the project has positive NPV. Okay, so let's say if the project has positive NPV of $100 million, so we are expecting that by investing in particular project, the company worth, the shareholder worth will increase by $100 million. That is a direct measure. Similarly, if we talk about IRR, the one advantage of IRR is it tells us, it's a profitability measure. It gives us the answer in terms of profitability, in terms of percentage. Okay, and IRR, it's a kind of margin of safety. How much below the IRR the actual project return could fall before the project becomes uneconomic. Why? Because IRR is a return at which NPV is 0. So let's say if IRR is 10%, okay, and the current or the required return of the project is, let's say, 11%. Okay, so 11%, this is the required return, and internal rate of return is 10%. So if the required return fall below 10%, then the project will have negative NPV. So that means from between 11% and 10%, there is a margin of safety. If the return is 10.5, I am in the money. If the return is 10.1, the project is in the money. So this is what we are saying, that how much below the IRR the actual project return could fall before the project becomes uneconomic. Now, what is a major disadvantage of IRR? IRR assumes that whatever the cash flows we are receiving from the project over the life, those cash flows, those interim cash flows will be reinvested at IRR, which is unrealistic, or which may be unrealistic, right? And we have discussed the second problem already, that in case of unconventional cash flows, we may have different multiple IRRs, and the interpretation would be difficult. So now let's move to return on invested capital. So far we have been discussing, or we have been analyzing the specific particular projects, like we were using IRR, we were using net present value. So remember, the IRR and net present values, those methods are project specific, right? So whether you should invest in a project or not, you should decide based upon the net present value or based upon IRR, right? But now we are analyzing a company, whether we should invest in a company or not, right? So for this purpose, we have one metric apart from other different metrics or measures that we will be using in the financial statement analysis, is the ROIC, return on invested capital. Okay, so the formula is very simple. You will take the net operating profit after tax divided by average book value of invested capital. Okay, so how we are going to calculate the invested capital? There are two formulas through which we can calculate the invested capital. So we have two formulas to calculate invested capital. One is called balance sheet approach, and second one is called working capital approach. So these two formulas you need to remember. We will take total debt plus total equity minus non-operating assets, or you will take the net working capital, which is current assets minus current liabilities plus net fixed assets. So this is the formula that we use to calculate the invested capital, which is in the bottom. And remember, this is average book value. So let's say in the exam, obviously you will be given, for average book value of invested capital, let's say we wanted to calculate ROIC for 2026. So you will have two balance sheets, 2026 and 2025, right? So 2025 and 2026, these two balance sheets. So you will calculate the invested capital for both these years. Invested capital for 2025, let's say it is $125 million. Invested capital for 2026, let's say it's also $125 million, or let's say it is $150 million, right? So what we are going to do is, or let's say it is $175 million. So now I am calculating ROIC for 2026, and which invested capital should I use? The answer is average. So you'll take average. So 125 plus 175 divided by 2, which is 150, is your average book value of invested capital, right? And where you are going to take net operating profit after tax, very simple. You will take operating profit, and then that should be after tax. So for example, whatever the tax rate would be given, so you will take operating profit multiply by 1 minus tax rate, or operating profit is this EBIT, earning before interest and tax, multiply by 1 minus T. So this is your NOPAT. So this is one way of calculating return on invested capital. Another way of calculating return on invested capital is this formula, where we will take the net operating profit after tax, which is this is the margin, okay, operating margin after tax. So ROIC can be calculated as, so operating margin after tax multiplied by capital turnover. So depending upon the exam, how data is given, how data is phrased, you can use these two formulas. One formula is this, return on invested capital, and in first formula, return on invested capital, I taught you how to calculate average book value of invested capital, and first of all, obviously, how to calculate invested capital. So we have learned two formulas, and then how to calculate NOPAT, which is simple, EBIT times 1 minus tax. Second formula is you will take operating margin after tax multiply by capital turnover. So this is a formula for operating margin after tax, and this is a formula of capital turnover or asset turnover, right? So remember these two formulas. Now, how can I increase my return on invested capital if I want? Number one point is increase your operating margin after tax. And if you wanted to increase your operating margin after tax, your tax should be lower so that your operating margin after tax is higher, or your operational expenses should be lower so that your operating margin is higher, right? Or we can increase the invested capital turnover, right? So there are two ways, either increase your operating margin or increase your capital turnover. And how we analyze that? ROIC, we compare ROIC with required return. Clearly, if ROIC is greater than required return, that means the company is adding value. Remember, I am repeating again, we are not analyzing project, we are analyzing companies, right? So that's why we are looking at company. That's why our conclusion is company, right? So as long as ROIC is greater than required return, which is a blended rate, which is the weighted average cost of capital, we will look in the upcoming reading how to calculate the weighted average cost of capital. All right. Okay, so what is the benefit of using return on invested capital, right? So first benefit is return on invested capital is based upon accounting data, right? Any investor who has access to the financial statements of the public listed entities obviously can calculate ROIC. But if I am the outside investor, can I calculate the net present value of the projects companies are taking? No, I cannot. I do not have any idea about the cash flows of those projects companies are taking. IRR, clearly, again, I cannot calculate. Why? Because these are the project specific. I don't know which projects companies are taking or considering to take, right? So these are the NPV and IRR. So one reason or one benefit of ROIC is it's the data is because it is based upon accounting financial data which is available to any investor, either it's inside outside, so we can calculate as an investor. It's beneficial for shareholder. Secondly, as I have been saying it again and again, net present value and IRR, these are project specific, these are not company specific. Okay, so let's say if companies are taking to decide which machinery we should purchase, okay, which vessel we should purchase, which ship we should purchase, right, for energy, oil, things like that. Okay, so project specific, different projects will have different NPV and IRR. But when we say ROIC, we are not looking at the individual project, we are looking at as a company how much capital was invested, and in return how much we are generating, right? So this is why we look at in detail invested capital and all that. What's the issues with the ROIC? Number one issue is accounting treatments may differ, obviously. So one way of analyzing ROIC is I can compare ROIC with the required return. Another way is I can compare the ROIC of different companies. So I can compare that what is the ROIC of company A and what is the ROIC of company B. So let's say company A ROIC is 10% and company B ROIC is 12%. Okay. Now without digging in detail, without further digging, I would say let's go for company B. Company B is adding value. But hold on, the return on invested capital is calculated based upon financial accounting data. Company A accounting treatment may be different. So let's say company A is using reducing balance method for their depreciation calculation and company B is using straight line method for depreciation expense. So clearly straight line method depreciation expense will lead to lower depreciation, and lower depreciation means high profit. High profit means higher ROIC. Okay, so comparison would be difficult. That's a one issue. Secondly, ROIC is based upon historical data, not forecasted data. So obviously the historical data, which is the actual data, will be different every year, which is volatile. The third point is, as we have been discussing, that ROIC is based upon the whole company. Okay, so like in this company, even though the companies are generating good return on invested capital compared to required return, but it doesn't tell us that which of the following projects or which of the projects companies are taking are loss making. We cannot evaluate that which projects of our which projects companies are taking are loss making. Okay, because yes, by looking at ROIC, we'll say okay, the company is good, company will add value, but when the projects will turn out to be a loss making in future, ROIC obviously will be lower. Okay, so that's why for analyzing the projects, we'll go for IRR and NPV, but for company analysis, we go for return on invested capital. So let's talk about what are the principles of capital allocation. Number one principle is it must be after tax. Before after tax, it must be cash flows. I mean, can we use accounting income for calculation of our net present value or IRR? Or I mean, can we use the accounting income for capital allocation decision making or capital projects? No. So it must be cash flows. When we are evaluating projects, I mean, we cannot evaluate the projects based upon their accounting income, because accounting income, they follows the accounting rule like accruals. Okay, they does not follow the timing of the cash flows, but we are concerned about the timing of the cash flows. Okay, so number one thing is it must be cash flows, and second thing, it must be after tax. The cash flow must be after tax. Okay, secondly, it must be incremental cash flows, the cash flows that are increasing because of the project. If we undertake a project and because of that project costs are increasing, okay, then the increase in cost is relevant. Let's say if previously let's say we have this factory and the rent of this factory was 40,000. Now we wanted to purchase a new machinery and install that machinery in this factory, but the land is insufficient, so we have to purchase a new, or we have to extend this factory land, right? So probably we can take a new land on a rental. Okay, so the rent will increase from now the 40,000, the combined rent would be, let's say, 60,000. Okay, so the rent was increased from 40,000 to 60,000 is because of our project which we are undertaking. If we do not undertake the project, then the cost would be saved. Okay, so the incremental cost, which is 20,000, which is because of our project, is relevant. Okay, the cost that has already been incurred, for example, research and development cost, for example, consulting fee, okay, they cannot be avoided. Either you decide to take a project or not, because the cost has already incurred. So sunk cost is irrelevant. Committed cost is also irrelevant, because committed cost has no link with the project. Okay, so either you want to take a project or not, the cost will be incurred at any cost because it's a committed. And then how the project cash flows, or how the launching of a project is affecting the cash flows of other products. So let's say if the Lay's has introduced a new the wavy green Lay's. Okay, so what is that impact? How does this affect to the other product of Lay's? Okay, so if because of this new product the other product sales are increasing, then that is called positive externality. By how much other product sales are increasing because of this product, we should include that in our analysis. And secondly, it can be opposite, which is more common, that if we introduce a new product, because of that new product other existing product sales would fall. By how much? Okay, so that is relevant cost for me. The loss that we are making on other product because of the new product is relevant for us, and this effect is called cannibalization. If because of the new wavy green other the salty Lays or the other products like yogurt and herb, those products are sales are declining, that is called cannibalization. Okay, so this is these effects we should also consider in our analysis. And the most important, obviously, the timing of the cash flow. So here we will be analyzing payback period, the projects that have lower payback period. So let's say if there are two projects, both are profitable, both are excellent, but the project A payback period is 2 years and project B payback period is 2.5 years. So obviously I would prioritize this project because this project is going to give the return of my cash flows. Return, it's not a return on, it's a return of cash flows in 2 years. So let's say if I am investing $100 million today, I'm expecting that I would recover this $100 million in just 2 years, right? So this, why we are analyzing it? Because of the time value of money. The cash flows that received earlier have more worth, okay? Now, because we are doing the forecasting, so obviously, as a human being, there can be some psychological issues, errors, biases. Some errors are called cognitive. Cognitive errors are, for example, the poor forecasting. If the forecasting is poor, obviously the project cash flows are poor, and this would have the negative effect, obviously. And secondly, if we are not considering the cost of internal fund. Okay, so let's say I need $100 million for investment in project A. One way is borrow the money from, or raise this money from outside the organization, or other way is retain earnings, do not pay the dividend. Let's say the net income is $100 million, which is I need. Okay, so do not distribute any cash flow, do not distribute any dividend, halt the dividend, cut the dividend this year. Obviously this would have a negative effect. Let's say you are the shareholder. If you would have received the dividend, you would have invested this dividend in another company. So my opportunity cost is, let's say, 10%. Okay, so this is called the cost of internal fund. If we are not distributing dividend to the shareholder are missing this 10% return, which they could have been generating by investing this dividend. But because we are cutting this dividend because we need cash flows, so generally the cost of internal fund is equal to the required return or cost of equity, right? And the last is, if we are not considering inflation appropriately, or the cash flows are on a real basis, but we are not considering it on a real basis. I'm taking I'm taking nominal inflation rate rather than real. I mean nominal inflation, not actually nominal inflation rate, it's a nominal discount rate. Okay, so my discount rate should be adjusted for inflation. If I am taking real cash flows which are adjusted for inflation, so my discount rate must also be based upon the real basis. Okay, so there are some other biases which are called behavioral biases. Number one behavioral biases is pet project, because let's say if you are analyzing the project and you knew it came to know you that this project has a backing of CEO, it is preferred by CEO, or CEO has proposed this project, so obviously now my decision would be biased. I mean I cannot do anything. Even if I say that okay, do not invest in this project, I know that the company is going to invest because it is a decision of the CEO, right? So this is called my analysis would be biased. Secondly, over the years, if the companies have not changed their capital budget, I mean every year, if the capital budget is same, that means we have assumed that every year the opportunities are same, the profitable opportunities are same, which is, I mean, unrealistic. Every year the opportunities would be changing. Some year we will have lower number of profitable opportunities, some years we will have higher number of opportunities. So in the years we have lower number of opportunities, the capital budget should be lower, and in the year the opportunities are higher, capital budgets are higher. So if the capital budget is same over the course of year, that means management, board of directors, they are not analyzing capital budgets appropriately, right? So this is called anchoring of capital budget. Capital budget is fixed, kind of decided. Okay, and secondly, we can also compare the growth in capital budget with the growth in profits or growth in revenue. So if the capital budgets are growing at 2%, so my revenue should also grow at least 2% or more than 2%. Otherwise it can be a problematic sign from the perspective of analyst. Okay, third point is if the management compensation is based upon EPS or return on equity, what is going to happen? Let's say management know that there is a positive NPV project, so what should we do? Invest in this project. But let's say management is reluctant to invest in this positive NPV project. Why? Because their compensation is linked with EPS and ROE. If management invest in this project in the short run, the net income would be lower, expenses would be higher because of this investment, right? And which is not good for management. But foregoing positive NPV project means it's not good for shareholder. So that means what management is doing, management board of directors, they are preferring their own interest above the interest of shareholder, which is conflict of interest. Okay, so that's also the behavioral biases. And the last is management is just mimicking, following what competitors are doing. We are not coming up, management is not coming up with any new idea. So these are some behavioral biases and cognitive errors while evaluating different projects. Okay, so let's talk about the last topic of this reading is real options. Real options is just like the financial options, like put option or call option. What is call option, put option? Both are the option. Both gives the holder, the buyer, right to buy or sell something. So basically, when we are evaluating or when we are talking about options, right? So it's contingent in future. It's not the obligation. So let's say I have a call option. Call option means, let's say I have a right to buy and stock at an exercise price of $50. If in future, I mean, it's a right, it's not obligation. If in future the stock price exceeds this exercise price, let's say trading at $55, I will not exercise this option, I will leave this option. So this is called option. Okay, so now we are not talking about financial options, rather we are talking about real options. So we have timing options, I mean, depending upon the information you can continue project after 1 year, or you can continue project after 2 years, you can continue project after 3 years. It's the timing, it's not bound. We are not time bound that we have to start the project in 2026 or we have to start the project in 2027, right? So this is called timing option. Secondly, abandonment option. So let's say we start the project and the law if the loss if the present value of exiting the project, okay, if the present value of exiting the project is higher than present value of loss of continuing the business, then in that scenario I should stop that project. So what does that means? We'll talk about this in detail in economics topics. So for example, let's say the idea here is if business is not generating, if my average revenue is below my variable cost, that means the revenue that we are generating or expected to generate is not even sufficient to cover the variable cost. That means if I continue doing the business, if I stay in the business, if I stay in the project, my loss from continuing the business is higher. So at this point I should exit, I should shut down the business, shut down the plant, right? So this is what we are doing, but it's an option. I mean, once it doesn't mean that if we start a project we cannot exit or we cannot abandon that. So we have, yes, we have the option. The other option is expansion. Once we invested in a project, let's say $100 million, and the investment turned out to be very profitable. So what I can do, I can put more money and I can expand my projects or my investment. So this is called expansion or growth options. And the fourth point is flexibility options. So what is flexibility options? In future the managers have flexibility regarding the price, regarding the productions. Flexibility, I mean, depending upon the demand and supply, depending upon the elasticity of demand or inelasticity of demand, the management can increase or decrease the prices. So let's say if the demand is higher, supply is lower, management can increase the price. So but we have to make sure that if we are increasing the prices, the sales the sales or the number of units we are selling should be unaffected, which is basically other way of saying, technical way of saying is it should be inelastic. Otherwise, if the product is elastic and the demand is higher and the management has decided to increase the prices, then the volume may go down with a greater percentage. Okay, so that's a price setting option. And then the production flexibility options, depending upon the demand from customers, from our clients. If we wanted to increase the production in future, can we? I mean, for example, we can pay overtime to our workers. Okay, so we can use different materials, we can use different production ways to increase the production. Okay, so that's a production flexibility option. So remember these points. Last option is fundamental options. What is fundamental options? Whether to invest in a project or not depend upon the price of that underlying product. Okay, so let's say I am deciding whether to open a copper mine or not. The decision is based upon the price of the copper. If the prices are lower, then it doesn't make sense to start a copper mine. Okay, so and if the prices are higher, then opening the copper mine would be a profitable. Okay, similarly, we also have the options depending upon the price. So when the prices would be higher, we will operate. When the prices would be lower, we will close. So that's a fundamental options. That's all about this reading. See you in the next class for the next reading. Bye bye. Take care.